The Bank of England just made a decision that will directly impact millions of UK households, and the consequences are far more significant than what's being reported in mainstream news. While financial analysts are focusing on the headline numbers, there's a deeper story unfolding that could fundamentally change how you manage your money over the next 12 months. What happened in Threadneedle Street this week isn't just another routine monetary policy adjustment. It's a signal that the economic landscape is shifting beneath our feet, and understanding what's really happening could be the difference between financial stability and genuine hardship for ordinary British families. Before we dive into the details, make sure you hit that like button and subscribe to Economy Reporter. We're bringing you the latest UK economic news that actually matters to your daily life, cutting through the jargon and explaining what these decisions mean for your wallet. Don't miss our upcoming coverage of housing market trends, inflation analysis, and everything else shaping Britain's economic future. The Monetary Policy Committee met this week and voted to hold interest rates at 5%, maintaining the highest borrowing costs the UK has seen in 15 years. On the surface, this looks like a straightforward decision to continue fighting inflation, which currently sits at 4.6%, well above the bank's 2% target. Governor Andrew Bailey stood before the cameras and delivered the expected message about price stability, sustainable growth, and data-dependent decisions. The pound sterling barely moved against major currencies, and gilt yields remained relatively stable. Financial markets had largely priced in this decision, with most analysts predicting the hold after recent economic data showed persistent inflationary pressures in the services sector. But here's what the official statement didn't emphasize. The vote wasn't unanimous. 2 members of the 9-person committee actually voted for a rate cut, arguing that the economy is showing clear signs of weakness that could tip into recession if monetary policy remains too restrictive for too long. This internal disagreement reveals genuine uncertainty about whether current policy is appropriate, and it suggests that future meetings could see significant volatility in decision-making. The statement also contained carefully worded language about monitoring labour market conditions and wage growth, which translates to concern that unemployment might rise faster than expected, while pay increases remain stubbornly high in certain sectors. What's happening behind these technical decisions is a mechanism that most people never fully understand, and that's exactly what makes it so powerful. When the Bank of England sets interest rates, it's actually determining the cost at which commercial banks can borrow money from the central bank. Those commercial banks then pass along these costs to consumers and businesses through mortgages, loans, credit cards, and savings accounts. But there's a crucial delay in this transmission process that creates winners and losers at different stages. Right now, we're in a phase where borrowers are feeling maximum pain, while savers haven't yet received the full benefit of higher rates. The inflationary environment that prompted these rate increases began with pandemic-related supply chain disruptions, energy price shocks following geopolitical tensions, and massive government spending programs. The bank responded by raising rates rapidly from near 0 to 5% over approximately 18 months, one of the fastest tightening cycles in modern history. This aggressive approach was designed to cool demand across the economy, making it more expensive to borrow and spend, while theoretically making saving more attractive. The intended effect is to reduce consumption, slow business investment, and ultimately bring down prices by creating economic slack. However, inflation is proving more persistent than policymakers expected, particularly in services where wages are a major component of costs. Food prices remain elevated even though energy costs have moderated from their peaks. Housing costs continue climbing despite higher mortgage rates because of fundamental supply shortages. This creates a painful squeeze where the cost of living stays high while the bank keeps interest rates elevated to combat that very problem, effectively hitting households from both directions simultaneously. For the average mortgage holder, the impact of sustained high rates is genuinely severe. Someone with a £200,000 mortgage on a standard variable rate is now paying approximately £600 more per month compared to 2 years ago when rates were at historic lows. That's £7,200 annually coming straight out of household budgets, money that previously went toward groceries, holidays, children's activities, or savings. fixed-rate mortgages are providing some temporary protection, but approximately 1.6 million UK households will see their fixed-rate deals expire in the next 12 months, and they're facing brutal refinancing conditions. The calculations become even more stark when you examine first-time buyers. The average UK house price currently sits around £280,000, requiring a mortgage of approximately £224,000 with a 20% deposit. At current rates, monthly repayments on a standard 25-year mortgage exceed £1,400, compared to roughly £900 when rates were at 1%. This represents a 55% increase in monthly housing costs, pricing out thousands of potential buyers who are already struggling with deposit requirements and pushing home ownership further beyond reach for an entire generation. Variable rate. Mortgages are experiencing immediate impacts, with payments adjusting within weeks of bank decisions. Fixed-rate holders have temporary insulation, but the mortgage market has already priced in expectations that rates will remain elevated well into next year. New fixed-rate deals are being offered at 6% or higher, substantially above the bank's base rate due to lenders building in risk premiums and profit margins. Tracker mortgages, which move directly in line with the base rate, are leaving families exposed to any future increases without the certainty that fixed rates provide. On the savings side, the picture is frustratingly mixed. While headline savings rates have increased, most traditional high street banks are offering deposit rates well below the base rate, sometimes as low as 1 or 2% on easy access accounts. This means that despite the bank holding rates at 5%, savers are receiving real returns that barely keep pace with inflation, or even fall behind it. The gap between what banks charge for lending and what they pay for deposits has widened considerably, representing a transfer of wealth from savers to financial institutions that's rarely discussed in mainstream coverage. The best savings rates currently available are coming from challenger banks and online platforms, where you can find accounts paying 4 to 5% on easy access balances and slightly higher on fixed-term deposits. However, these rates come with caveats, including deposit limits, restrictions on withdrawals, and the need to actively manage multiple accounts to maximize returns. The complexity creates a barrier that prevents many people from accessing the best rates, particularly older savers who may be less comfortable with online banking, or those without the time to constantly compare products and shift money between institutions. Credit cards and personal loans are experiencing their own interest rate explosion, with typical APRs on credit cards now exceeding 25% for many borrowers. Personal loan rates vary dramatically based on credit scores, but even those with good credit are seeing rates in the 8 to 12% range. This makes debt consolidation increasingly expensive and traps people in high-interest borrowing at exactly the moment when household budgets are already stretched. The bank's decision to hold rates means these painful borrowing costs continue without relief, potentially forcing difficult choices between paying down expensive debt and covering essential living costs. Small businesses across Britain are feeling these interest rate decisions just as acutely as households, though their struggles receive far less attention in mainstream coverage. Business loans and commercial mortgages have seen similar rate increases, making it dramatically more expensive to invest in equipment, expand operations, or even maintain existing facilities. A manufacturing company looking to purchase new machinery or upgrade production lines now faces borrowing costs that can make projects economically unviable, even when the investments would improve efficiency and competitiveness. Service businesses that relied on credit lines to manage cash flow during quieter periods are finding those facilities either withdrawn or repriced at punishing rates. The hospitality sector is particularly vulnerable, having barely recovered from pandemic closures before being hit with energy cost spikes and now elevated debt servicing. Restaurants, pubs, and hotels that took on debt to survive recent years are discovering that refinancing is either impossible or available only at rates that eliminate any profit margin. This is contributing to the wave of closures we're seeing across high streets, where establishments that survived for decades are finally surrendering to an economic environment that's become fundamentally hostile to their business models. When these businesses close, they take jobs with them, creating ripple effects through local economies that extend far beyond the immediate loss. Employment implications are already becoming visible, though they're developing more slowly than the direct financial impacts. Companies facing higher borrowing costs and weakened consumer demand are responding by freezing hiring, eliminating open positions, and, in some cases, beginning redundancy consultations. The unemployment rate has ticked upward to 4.3% from its recent low of 3.5%, and most economists expect further deterioration over the coming months. Graduate employment prospects have dimmed considerably, with major employers reducing their intake programs and smaller companies abandoning plans to bring on junior staff who require training investments. Wage negotiations are creating a difficult dynamic where workers are demanding increases to offset inflation, while employers are pleading poverty and warning that excessive pay rises will force job cuts. Public sector workers, including teachers, nurses, and civil servants, have been particularly vocal about real terms pay cuts after years of below-inflation increases. However, the Bank of England views wage growth as one of the key drivers of persistent inflation, creating a perverse situation where workers fighting to maintain living standards are identified as part of the problem rather than victims of it. This fundamental tension between the need for price stability and the legitimate demands of working people for fair compensation remains unresolved. Investment decisions across the economy are being dramatically affected by the current rate environment. Property developers are shelving projects because financing costs make development uneconomical, even in areas with clear housing shortages. Infrastructure projects that made sense at 2% borrowing costs look completely different at 6 or 7%, causing cancellations and delays that will have implications for years to come. Venture capital and private equity activity has slowed significantly, with higher interest rates making safe government bonds relatively more attractive compared to risky startup investments. This retreat of investment capital means fewer new businesses launching, less innovation, and reduced job creation from the entrepreneurial sector that often drives economic dynamism. High street retail is experiencing a particularly brutal combination of elevated rents, higher business rates, increased labour costs due to minimum wage increases, and weakened consumer spending power. Major chains have announced store closure programs affecting hundreds of locations, while independent retailers are disappearing at alarming rates. Town centres that were already struggling due to the shift toward online shopping are now facing an accelerated decline that threatens to create economic dead zones in communities across Britain. The bank's interest rate policy isn't the sole cause of these trends, but it's certainly accelerating dynamics that were already challenging. The political response to the bank's decision reveals deep divisions about the appropriate path forward. Labour has criticised the government for creating the economic conditions that necessitated such aggressive rate increases, pointing to policy failures including inadequate regulation of energy markets, insufficient investment in productivity-enhancing infrastructure, and Brexit-related trade barriers that have increased costs. They argue that the inflationary surge could have been moderated through different policy choices, and that working families are now paying the price for years of economic mismanagement. However, Labour has been notably cautious about criticising the Bank of England directly, recognising that central bank independence is considered sacrosanct and that being perceived as hostile to orthodox monetary policy could damage their credibility with financial markets. The Conservative position emphasises that inflation is a global phenomenon affecting all developed economies and that the bank's actions are necessary to prevent inflation from becoming permanently embedded in expectations and behaviour. They point to countries that initially hesitated to raise rates and subsequently faced more severe inflation problems, requiring even more painful policy responses. The government argues that short-term economic pain is preferable to allowing inflation to destroy savings, distort economic decision-making, and ultimately require even more dramatic intervention. However, this message rings hollow for families struggling with mortgage payments and grocery bills, who see their living standards declining rapidly regardless of the theoretical justification. Within the Conservative Party itself, significant tensions exist between those who believe the bank has been too aggressive and those who think more should have been done earlier. Some MPs are openly questioning whether central bank independence has led to groupthink and insufficient accountability for decisions that have enormous consequences for constituents. Others defend the institutional framework while suggesting that fiscal policy should be doing more to support households affected by necessary monetary tightening. These internal debates reveal uncertainty about how to navigate an economic environment that doesn't conform to traditional political narratives about either party's competence. Election implications are substantial regardless of when the next general election occurs. If rates remain elevated and the economy weakens further, the government will face voters who have experienced falling living standards, rising unemployment, and a general sense that Britain is heading in the wrong direction. Opposition parties will hammer home the message that years of conservative governance have left the country economically vulnerable and ordinary families worse off. Conversely, if inflation falls rapidly and the bank is able to cut rates before the election, the government will claim vindication for difficult decisions and argue that staying the course has protected long-term prosperity. The timing and trajectory of monetary policy could genuinely swing electoral outcomes by affecting millions of voters' economic circumstances directly. When we examine the UK's interest rate trajectory in international context, some striking patterns emerge that challenge simple narratives. The United States Federal Reserve has also maintained elevated rates, with the federal funds rate at 5.25 to 5.5%. Remarkably similar to the UK's position. However, the US economy has proven far more resilient than expected, with strong labour markets and robust consumer spending continuing despite the monetary tightening. This divergence suggests that the transmission mechanisms of monetary policy differ significantly between economies, possibly due to factors including the prevalence of fixed-rate mortgages in the US that insulate borrowers from immediate rate changes, different labour market structures, and varying levels of household savings accumulated during the pandemic. The European Central Bank has pursued a similarly aggressive tightening path, raising rates from negative territory to 4% in a relatively short period. European economies are experiencing similar struggles with persistent inflation, particularly in services, while manufacturing sectors show weakness due to energy costs and reduced demand from China. Germany, traditionally Europe's economic powerhouse, has entered recession and is grappling with structural challenges including an aging population, high energy dependence, and the need to transition its automotive industry away from internal combustion engines. These European struggles provide context for UK difficulties, demonstrating that current challenges aren't unique to British policy failures, even if domestic factors have contributed to the specific severity of impacts. Japan presents a fascinating counterpoint, having maintained near-zero interest rates for decades while dealing with deflationary pressures and demographic decline. The Bank of Japan has only recently begun to normalise policy, and even now rates remain minimal compared to Western levels. This alternative monetary policy regime demonstrates that there isn't a single correct approach to central banking, and that different economic structures and challenges may require fundamentally different policy responses. However, Japan's experience also suggests that once certain economic patterns become established, they can be extraordinarily difficult to reverse, with implications for countries currently making critical decisions about their monetary policy frameworks. Currency markets provide another lens for understanding the consequences of interest rate decisions. The pound sterling's value against major currencies is significantly influenced by relative interest rate expectations, with higher rates typically attracting foreign capital and supporting currency values. A stronger pound makes imports cheaper, helping to reduce inflation, but makes British exports less competitive in international markets and reduces the value of overseas earnings when converted back to sterling. Manufacturing exporters and companies with significant international operations face different incentives than importers or domestic-focused businesses. The bank must balance these competing interests while pursuing its primary mandate of price stability, creating complex trade-offs that have no perfect solution. Foreign investor sentiment toward UK assets has been notably cautious following the political and economic volatility of recent years. The Truss government's disastrous mini-budget temporarily shook confidence in British economic management, and although markets have stabilised, a wariness remains about the UK's policy environment and growth prospects. Higher interest rates should theoretically make British bonds more attractive, but if investors believe those rates reflect economic weakness rather than strength, the effect can be perverse. Similarly, elevated rates might normally support the pound, but if capital is flowing out of British assets due to concerns about long-term competitiveness or political stability, currency weakness can persist despite rate advantages. These dynamics demonstrate how monetary policy operates within a broader context of confidence and expectations that can enhance or undermine technical policy settings. Leading economists are offering varied predictions about what happens next, reflecting genuine uncertainty about how current dynamics resolve. The optimistic scenario suggests that inflation continues declining as energy price spikes fully drop out of year-over-year comparisons, wage growth moderates as labour market conditions ease, and the bank is able to begin cutting rates by late spring or early summer. In this view, the economy experiences a shallow slowdown rather than a severe recession. Unemployment rises modestly, and by late next year, conditions have improved enough that households begin feeling genuine relief. This positive outcome requires several favourable developments aligning, including no new external shocks, well-anchored inflation expectations, and policy adjustments that support activity without reigniting price pressures. The pessimistic scenario involves inflation proving more persistent than hoped, particularly in services where wage and rent components continue rising despite monetary tightening. In this darker trajectory, the bank feels compelled to either raise rates further or maintain them at current levels for an extended period, driving unemployment significantly higher and potentially triggering a wave of mortgage defaults and business failures. Consumer confidence collapses as households hunker down, retail spending contracts sharply, and the economy enters a recession that feeds on itself through negative feedback loops. Housing prices decline substantially as forced sellers exceed available buyers, creating negative equity problems for recent purchasers and threatening financial stability. This scenario isn't impossible, and some economists estimate perhaps a 30 to 40% probability of outcomes this severe. Between these extremes lies a muddling through scenario where inflation declines gradually but not rapidly. Economic growth remains weak but positive, and interest rates come down slowly over the next 18 to 24 months rather than through dramatic cuts. This extended period of mediocre performance would be frustrating and painful for many households and businesses, but would avoid the most catastrophic outcomes while also failing to deliver the rapid improvement that optimistic forecasters envision. Historical experience suggests that this middle path might actually be the most likely, as economies rarely transition smoothly between states and policy adjustments typically happen incrementally rather than dramatically. Where economists disagree most sharply is on the question of whether the bank raised rates too aggressively and has now over-tightened, or whether they were too slow initially and are still behind the curve. Those arguing for over-tightening point to leading indicators suggesting the economy is weakening faster than official data shows, with housing transactions, consumer confidence, and business investment all flashing warning signals. They worry that by the time the bank recognizes the damage being done and responds with rate cuts, a recession will already be well established and difficult to reverse. The concern is that central bankers are fighting yesterday's war against inflation, while the real threat has shifted to economic contraction and rising unemployment. The opposing view holds that inflation remains dangerously elevated, particularly in sticky components like services and rent, and that any premature easing would allow price pressures to reignite, ultimately requiring even more painful intervention later. Proponents of this perspective cite the 1970s experience when central banks prematurely declared victory over inflation, only to see it roar back even stronger, ultimately necessitating the brutal Volcker tightening in the early 1980s that drove unemployment to devastating levels. They argue that maintaining restrictive policy until inflation is clearly defeated is essential to credibility and prevents the far worse outcomes that come from losing control of expectations entirely. Historical precedents offer both reassurance and warning. The UK has experienced high inflation and elevated interest rates before, most notably in the early 1990s when rates briefly hit 15% during the ERM crisis. That episode ended with a sharp devaluation and subsequent period of strong growth, though with significant pain along the way, including a severe recession and housing crash. The 1970s stagflation period demonstrated how difficult it becomes to control inflation once it's embedded in wage price spirals, but also showed that economies can eventually emerge from such episodes and return to stability. More recently, the 2008 financial crisis response involved cutting rates to near zero and implementing quantitative easing, the reversal of which is part of what's making current tightening so dramatic. What makes the current situation particularly challenging is the combination of factors in play simultaneously. Previous episodes typically involved either inflation problems or growth problems, but rarely both at the same time, alongside historically high debt levels, aging populations, climate transition requirements, and geopolitical tensions that threaten energy security and trade relationships. The complexity of these overlapping challenges means that policy responses face difficult trade-offs with no clear optimal path, and the risk of unintended consequences is elevated. Central bankers are essentially navigating through fog, making decisions based on lagging data about conditions that may have already shifted, while trying to anticipate how various economic actors will respond to policy changes. Warning signs to monitor over the coming months include unemployment data, which is released monthly and provides a relatively timely indicator of labour market conditions. If unemployment begins rising rapidly, exceeding 5% or approaching 6%, it would signal that the economy is weakening faster than policymakers intend and could prompt monetary policy adjustments. Housing market data, including transaction volumes, mortgage approvals, and price indices, will show whether the property market is stabilising or entering a more serious correction. Retail sales figures indicate consumer spending power and confidence, while business investment data reveals whether companies believe conditions are improving or deteriorating. Inflation data itself remains the single most important indicator, with the bank focused intensely on both headline figures and core measures that strip out volatile food and energy prices. If inflation falls below 3% and continues declining, rate cuts become much more likely. If it stalls at current levels or rebounds, the restrictive policy will persist. Wage growth data is particularly significant because labour costs feed into service prices, and the bank views excessive wage increases as both a consequence and cause of broader inflation. Services inflation specifically is being watched closely as the component most directly connected to domestic demand and least affected by global commodity price movements. For mortgage holders facing refinancing in the coming months, concrete steps can help manage the transition to higher rates. First, review your current mortgage at least 6 months before the fixed term expires, understanding exactly when the rate resets and what your current deal entails. Contact your lender or a mortgage broker to explore options available in the market. Comparing not just interest rates, but also fees, flexibility, and terms. Consider whether a shorter fixed term might be appropriate if you believe rates will decline in the next few years, though this involves risk if rates instead remain elevated or increase further. Some lenders offer rate lock features that allow you to secure a new rate up to 6 months before your current deal ends, providing certainty even if rates rise further before your refinancing date. Overpayment strategies can reduce the principal balance and therefore the total interest paid over the life of the mortgage, though overpayments should be balanced against other financial priorities, including emergency funds and high-interest debt. Many mortgages allow overpayments up to 10% annually without penalties, and even modest additional payments can significantly reduce total interest costs over time. However, make sure you understand your lender's specific overpayment policies and whether overpayments reduce the term or the payment amount. Consider whether funds used for mortgage overpayment might generate better returns if invested elsewhere, particularly if your mortgage rate is relatively low compared to potential investment returns, though this involves risk and requires careful analysis. If refinancing at current rates would create genuine affordability problems, communicate with your lender early rather than waiting until payments become unmanageable. Many lenders have hardship programs, including temporary payment holidays, extended terms to reduce monthly payments, or interest-only periods, though these solutions have long-term costs, including higher total interest paid and delayed equity building. The Financial Conduct Authority requires lenders to treat customers fairly and work with those experiencing difficulties, so don't suffer in silence if you're genuinely struggling. However, be aware that using hardship provisions may affect your credit rating and future borrowing options, so explore all alternatives before going this route. Savings strategy adjustments should focus on maximizing returns while maintaining necessary liquidity and safety. Compare rates across multiple providers using comparison websites, recognizing that the best deals change frequently and require active management to capture. Consider splitting savings between easy access accounts for emergency funds and fixed-term accounts for money you won't need immediately, as fixed terms typically offer higher rates but lock up funds for specified periods. Understand the Financial Services Compensation Scheme protection, which covers deposits up to £85,000 per person per institution, and spread larger balances across multiple banks to ensure full protection. Premium bonds offer an alternative to traditional savings accounts, with prizes instead of interest, and the advantage that winnings are tax-free. However, the effective return rate depends on luck and is lower than the best savings accounts for all but the largest holdings. Cash ISAs provide tax-free returns up to the annual allowance, currently £20,000, though for most people, the personal savings allowance means they won't pay tax on savings interest anyway. Still, ISAs can be valuable for higher-rate taxpayers or those with substantial savings balances who would otherwise exceed the personal savings allowance. Investment portfolio considerations depend heavily on individual circumstances, including age, risk tolerance, time horizon, and existing holdings. Higher interest rates make bonds relatively more attractive compared to stocks, as fixed income securities now offer meaningful yields, whereas they provided minimal returns during the near-zero rate environment. However, existing bonds lose value when rates rise, so bond funds may show paper losses, even though newly purchased bonds at current rates will provide better returns going forward. Younger investors with long-time horizons might view market volatility as a buying opportunity for equities, which historically outperform over extended periods despite short-term fluctuations. For those approaching retirement or already retired, the balance between growth and security shifts significantly. The temptation to lock in higher-yielding bonds or cash deposits must be weighed against inflation risk over potentially decades of retirement. Annuity rates have improved dramatically as interest rates have risen, making annuities more attractive for those seeking guaranteed income, though the inflexibility and loss of capital remain significant drawbacks. Drawdown strategies need reassessment given the changed interest rate environment, with the optimal path depending on individual tax situations, spending needs, and legacy goals. Professional financial advice becomes particularly valuable when navigating these complex decisions with significant long-term consequences. When to lock in rates versus waiting is perhaps the most agonizing decision facing both borrowers and savers. For mortgages, the conventional wisdom suggests locking in a competitive fixed rate when you find one rather than gambling on future improvements, particularly if the rate allows you to budget comfortably. The cost of being wrong about rate direction is significant, as waiting for lower rates that don't materialize means paying higher variable rates for months or years. However, if you have genuine inside information suggesting rates will decline soon, or if expert consensus strongly indicates imminent cuts, waiting might make sense despite the risk. For savers, the calculus differs because there's no penalty for remaining in easy access accounts other than potentially missing out on higher fixed-term rates. If you believe rates will decline soon, locking in current fixed rates makes sense to preserve returns for the term period. If you think rates will remain elevated or potentially increase further, staying in variable accounts lets you benefit from future increases without being locked into today's rates. However, predicting monetary policy is notoriously difficult, and the safest approach involves splitting balances between fixed and variable to hedge your bets rather than going all in on one scenario. Resources for getting personalized advice include mortgage brokers who can access the entire market, and find products suited to your specific circumstances, often at no cost because they receive commissions from lenders. Financial advisors can provide comprehensive planning covering not just mortgages but also savings, investments, pensions, and protection policies, though fee structures vary, and you should understand costs before engaging. The Money and Pension Service offers free guidance on various financial decisions, while Citizens Advice provides support for those facing debt problems or financial hardship. Online tools and calculators can help with basic decisions, but complex situations with substantial sums at stake typically warrant professional guidance. This interest rate decision represents far more than a technical adjustment to monetary policy. It reflects fundamental questions about the kind of economy we want to build and who bears the costs of maintaining stability. The Bank of England's mandate focuses narrowly on inflation control, but the consequences of pursuing that mandate ripple through employment, housing affordability, business investment, and ultimately, the life chances of millions of people. As rates remain elevated and economic conditions evolve, the coming months will reveal whether current policy represents a necessary response to genuine inflationary threats or an overreaction that drives unnecessary hardship. The number to watch going forward is 5%. That base rate figure will determine mortgage costs, savings returns, business investment decisions, and employment prospects for the foreseeable future. If it begins declining in the coming months, relief is on the horizon. If it stays fixed or edges higher, brace for continued pressure and potential deterioration. And if it falls too quickly because the economy has weakened dramatically, that apparent good news might actually signal deeper problems requiring even more dramatic interventions down the road. Here's the question that matters most. In an economy facing simultaneous challenges including productivity stagnation, demographic aging, climate transition costs, and geopolitical uncertainty, can traditional monetary policy deliver the stability we need without causing so much collateral damage that it undermines the very prosperity it's meant to protect? The answer will shape Britain's economic trajectory for years to come. If you found this analysis valuable, hit that like button and make sure you're subscribed to Economy Reporter. We're cutting through the noise to bring you UK economic news that directly affects your financial decisions. Drop a comment below with your thoughts on interest rates and how they're affecting you personally. Are you locked into a favourable mortgage rate or facing painful refinancing? Have you found savings accounts that actually pay decent returns? Share your experiences and let's build a community that helps each other navigate these challenging economic times. Thanks for watching, and I'll see you in the next one, where we'll be diving into the latest housing market data and what it means for buyers, sellers, and renters across Britain.